Welcome back, and joining me now as we recap on the day's markets action is Viv Govender from Rand Swiss Offshore. Viv, thanks so much for joining us today. Now, it is the first full week of trade for the last month of 2023, and it's been quite mixed. I guess a number of traders are practicing some caution as we've had the US jobs numbers under the spotlight, right?
Oh, yes, most certainly. I mean, the last, I think, couple of months or so, the market has really turned positive, and primarily due to dropping expectations for US interest rates. I mean, look at the US 10-year bond yield. I mean, it's come down from just about 5 to, I think yesterday I saw it just below 4.1. That is like 0.9%. That's a substantial, that's equivalent to almost 4 rate cuts, the normal 0.25% rate cuts. So the market is really optimistic about rate cuts going forward, and that has to be backed up by a couple of things. Falling inflation and a weak U.S. job market. If employment is too strong, and we see, for instance, wage growth going specifically about 5%, 4%, sorry. If we see wage employment beating expectations, that I think would be very negative for markets today.
Now, this all, of course, coming ahead of the Fed's next policy meeting, which is the last one for the year, taking place next week. And I mean, Viv, the Fed has been quite assertive about data and how it influences its decisions. Surely we're going to get a hold, right, with the expectation of cuts next year.
Yeah, look, I mean, the market is pricing not just holding cuts next year. The price, I think, there's a 60% chance of a cut in the first quarter. That's basically by March. And if you look until the middle of the year, June, July, then there's a 99-point-something% chance of a rate cut. The market's pricing in by the middle of next year. So the market's pretty much saying there has to be a rate cut by the middle of next year. And it's going to get wrong, very badly in the past. I mean, good at the start of 2022. And you look at what the expectations for rate cuts were in 2023, and there were, significant chances that by now we'd be cutting rates. So the market's gotten this wrong a couple of times. And one thing I do worry about is that the US Fed does use the 10-year yield and, the bond market, et cetera, as indicators of whether the strategy is working. The fact that we've seen, bond yields come down as dramatically they are in the market may mean the Fed has to be a bit more aggressive in terms of either its tone, maybe even its actions, on the next meeting.
And I guess that means we just shouldn't get too excited too soon. Over in Europe, we have the ECB also delivering their last policy decision for the year next week. And we've been talking about this. Things on that end are starting to show that the interest rate hikes are starting to work. Inflation is easing. We're seeing economic prospects quite starting to dampen, and just general growth on that end is starting to contract. I was reading something this morning with a lot of analysts saying that they expect to see rate cuts in Europe as soon as the first quarter of next year. Do you think that's likely?
Look, I mean, for that to happen, I mean, the ECB has been a bit weaker than the Fed. I mean, for the Fed to cut in the first quarter, which I said, there's more than a 50% chance the market pricing it right now. I would expect there to be a significant pullback. The ECB has been a little more, dovish on these kind of things, so it's possible that we could be seeing something like that there. And I think Deutsche Bank is pricing the first cut in April, which is slightly beyond the first quarter, but still round about that kind of timeline. So I think it's quite possible that we do see a rate cut come through in the ECB in the first quarter of next year. Economic growth in Germany has been worse than expected. We saw the German manufacturing PMI coming out, or index coming out recently. And I think if you look back, I think it was indexed in 2015. So 2015 was like a baseline. And 2023, current time, is like 96, which shows like a 4% fall over the last 8 years or so for the economy. They are doing really badly at the moment. We are seeing, weak growth across the entire Eurozone. In fact, the US is doing much, much better. The US, the last number we got from them was like 5.2% growth annualized the last quarter. That is like adding the entire economy of Russia in the last year to the US economy. That just shows how powerful that economy is.
Over in Asia, there was trade data out from China with exports climbing 0.5% and imports falling 0.6% year on year in November. Quite underwhelming for economists as they expected a 1.1% decline in exports and a 3.3% jump in imports. Now, Viv, does the data suggest that Beijing isn't out of the woods just yet and that there could still be economic pain down the line?
Yeah, look, I mean, unlike some places like the US, for instance, that has a temporary problem, Beijing has some real long-term issues. Firstly, it's facing difficulties due to sanctions from the US and like the European Union, etc., with regards to getting its chip industry up and running. The US has banned not just the export of chips, the export of machines used to make chips, the ability of people with American citizenship to work in China on certain kinds of things, the ability of Americans to basically invest in certain projects in China. So they really are going all out to make sure that the Chinese don't have a step up on the next ladder. I mean, the next ladder is AI technology primarily, and that the Americans are trying to make sure they don't get that. They have a massive property bubble that's bursting. The number of unsold, residences in China going up dramatically. Noticed a couple collapses of companies, Evergrande, etc. And we are also seeing, a demographic issue hitting them that's going to be a drag on that economy for the next several decades. So yeah, China is by no means out of the woods yet.
Let's get into some company news now. The Anglo Stable came out with some updates. Commentary from the miners rather, is quite similar, dealing with a tough macroeconomic tough macroeconomic environment. We also have Amplats in particular, being hit by those PGM prices. Some of them are slashing output, and I think generally just trying to keep a lid on costs through cost-cutting initiatives. Viv, just take us through your analysis of these updates.
Yeah, look, the platinum price at the moment is like in the low 900s. According to actuals, Amplats, their all-in costs are like about $1,050, over $100 more than the current price. Look over the last year or so, and you find only a few periods, a few weeks effectively, where the price would have been profitable for Amplats to be producing. For the majority of the time, it was below the break-even price of the company. So they are seeing their costs basically being higher than the cost of the product they're producing, which is never a good sign. And this is a major issue for not just Amplats and the platinum producers, but the country as well. Of the mining sector, the platinum producers are the biggest employers. I think it's like 170,000 something people are employed by the platinum producers. The problem the platinum producers have is, multifold, and not just the issues in South Africa on load shedding and all the other issues about transport and whatnot, but also the fact that their biggest source of demand for their commodity, platinum and platinum group metals, is internal combustion engines. And anyone that looks at anything at the moment knows that the electric vehicle rise is occurring. Of course, Tesla is doing quite well. Some of the GMs sort of pulled back a little bit, but governments are supporting the idea of electric vehicles. Some of them are banning internal combustion engines as early as 2035. So when your biggest source of demand is disappearing, this is never a good sign for any industry.
Let's get into the banking sector, where we had ABSA release a trading update forecasting higher revenue, but markets remain quite wary about those bad debts as it expects credit losses to remain high. Surely this is just clear evidence that South Africans are buckling under the pressure and as those interest rates remain elevated, right?
Yeah, I mean, banks have a two-edged sword when it comes to interest rates. You raise interest rates, they can add on more profitability, so they earn more in terms of interest returns and so on. But if you basically also see the situation where people can't afford to pay back their loans, and therefore there's more defaults. And so I do think that is a real issue in South Africa. We have seen banks' profitability rise, over the last year or so, as interest rates have suddenly rise quite a bit. But we also are seeing, consumers, like I said, buckling. And if this continues for much longer, I think we are going to have a real difficulty over the next year or two. Luckily, if the US is cutting interest rates next year, if the ECB is cutting interest rates next year, there is a significant chance that we could do the same, especially if we see our inflation number moderated. But I think that probably will occur. It's one of the things that affected us last time around. The last inflation number that was higher than expected, bring us close to the top of the 6% barrier. With things like food inflation, I think is moderating. Also, other things moderated is the oil price has come down dramatically to below $80 a barrel for Brent. The rand is a bit stronger. So hopefully with that combination, we could see interest rates fall a bit.
Crossing fingers for those rate cuts come next year. But before I let you go, what's your stock pick?
I maintain Alphabet. I love the company. It just came up with a new product this week called Gemini, which is the AI. And if you want to be amazed by what AI can do currently, just go and look at the demos for AI, for Gemini AI. And in fact, it's I think available on Bard at the moment. It's the next step from GPT-4. And remember, GPT-4 only came out 9 months ago, so the progress has been amazing. And right now, I do think that Google has the lead in this sector, and we've seen the share price react positively on the news as well.
Viv, thanks so much for your time and those insights. That was Viv Govender from Rand Swiss Offshore.